In this presentation, we will enter a reversing entry related to the adjusting entry of accounts receivable or an invoice. In other words, we had entered an invoice in a prior presentation and an adjusting entry related to that invoice, the invoice having been entered after the cutoff date, our cutoff date being the end of February. So it was entered in March, but the work was done in February. Therefore, we did an adjusting entry to bring that data or that information, the revenue and the accounts receivable and the related inventory and cost of goods sold and the sales tax payable back into February as of the cutoff date. Now we need to do a reversing entry related to it so that it is not entered two times as of March. We'll do this within QuickBooks Pro 2020, QuickBooks Desktop 2020. Here we are in our Get Great Guitars file. We currently have the Open Windows open. You can open the Open Windows by selecting the View dropdown and go into the Open Windows list. Last time we entered an adjusting entry related to accounts receivable. Let's first take a look at that. We're going to go to the Reports dropdown. We're going to go to the Company and Financial and first open up the balance sheet. Within the balance sheet, we're going to go to the Customize Reports. And I'm going to change the dates down below from 01/01/20. We're going to make this go through March. Our cutoff date is February, but we're going to make it go through March for this particular example to see the scenario of what has taken place so far. So I'm going to make it 03/15/20. So January through March 15th and OK. Then let's open up the profit and loss report and do the same thing with it. We're going to go to the reports drop down up top. We're going to go to the company and financial. We'll take a look at the profit and loss standard report. And then we'll change the dates. We'll change those dates to 01/01/20 to 03/15/20. Now, the scenario is that there was an invoice that was entered after the cutoff date. We can see that by taking a look at the merchandise sales. Let's take a look at that, double-clicking on it. We see the invoice down here was entered in March. So it was entered March 2nd. And it should have been entered according to the revenue recognition principle before February. Now, instead of adjusting the date of the invoice, because the invoice has been put in place in accordance with our normal accounting system, we then are going to make an adjusting entry in order to bring the revenue, as we did here, back into March. However, by doing so, back into February. However, by doing so, as of the date that the original invoice was entered in March, it has now been entered two times. And of course, that's going to be a problem for us. Therefore, we want to make this adjusting entry as of February to make the financial statements correct as of the cutoff date as of February so that we can print the reports and have everything on an accrual basis as of that date. Then, and the first day of March, we're going to reverse it. Now, note that we don't typically wait till, in this case, we had the second day of March is when the invoice was put in place. We typically want all of our reversing entries as of the first day of the next period. That makes them easy to locate. So we're not looking for perfect accrual in the middle of the month here. We're looking for the accrual to work out as of the end of the month, make the adjusting entries in order to adjust those accounts that need to be adjusted to be on that accrual basis and have the most efficient accounting system during the time period in between that. So to do that, I'm going to close this back out. We can see the same thing if we take a look at the cost of goods sold, double-clicking the cost of goods sold, we see that we have the invoice and we have the journal entry. So those are entered twice. We're good as of the end of the month. However, we need to make a reversing entry so it's not duplicated at the start of next month in March. Let's take a look at, close this back out. Take a look at the balance sheet where we have the same scenario. We have the same scenario in accounts receivable. Double click in the accounts receivable. And if we scroll down, we see the same kind of thing. 228 was, of course, the journal entry, making us correct as of the cutoff, but now it's in there twice as of the invoice date of March 2nd. And then we also see that in the inventory, double-clicking the inventory, same scenario down here, and of course, finally, the payable down below. So we've got the sales tax payable. All right, so we have to do a reversing entry. So how do we do a reversing entry? We're going to do a journal entry to do it because it's a long entry. We're not going to use the registers to do it. But the best way to do it is actually to think about what would be the normal entry and then just simply reverse it exactly. So in other words, if we were to go into the invoice here, the actual invoice, and think about what the journal entry was for the invoice, which we had made. We can actually look at the journal entry because we entered it, but for the invoice, we know the journal entry would look something like this, right? It would increase accounts receivable to an invoice by the 525, increase the sales by 500, increase the payable by the 25, increase the cost of goods sold by whatever the cost is. I believe it's 400. It's not on the invoice, but it's driven by this item. Increase and decrease the inventory by that 400. So it would look like this. Accounts receivable, sales increases. Now, if we think about the debits and credits, accounts receivable increases with a debit. Sales or revenue increases with a credit. The sales tax payable is going to increase with a credit. Cost of goods sold increases with a debit. Inventory decreases with a credit. Once we have that, then we can just reverse this exactly. So I could just take these amounts and say, all right, now I'm just going to reverse them. And we'll make this over here. We'll make these over here. Or let's just do it this way. I'll just say that this is going to be a credit of that amount, and a debit of that amount, and a debit of that amount, and a credit of that amount. And so we'll just reverse it exactly. If you were to create this journal entry, it would kind of mess your mind up because you'd be going, okay, here's what the normal invoice, now we're going to reverse it. It would then be going down, and then the sales normally goes up, but sales is going down, and sales never normally goes down. So it'll kind of be hard to wrap your mind around that if you just try to create it. Try it, it's worth doing. But the easy way to do it is to think about, okay, here's the journal entry that what happened when we made the invoice, or the adjusting entry we made for the invoice, then just reverse them exactly. Also, when I see people do this, they often say, well, I can't do it this way because I have to put the debits on top and the credits on the bottom. No, you don't. You don't have to do that. You only have to do that if you have a very picky person looking at you, or if you, if you want to be more appropriate for some reason. That's just kind of a convention. Typically, software will do that because the software will use that convention. But I mean, if it makes more sense to you, as it would here, to reverse them exactly, top to bottom, it's much easier. I mean, if you start moving the order of these accounts around, then it gets a little confusing. So in this case, anytime you have to reverse something, a credit memo, for example, same kind of process. Think about the original journal entry, reverse it exactly. Don't start saying, well, I can't do it that way because there's a credit on top and that doesn't work. If you have to then do this and then shuffle it around to make it look prettier to somebody, that's okay. But as long as the debits and credits are on the right side, it'll work. So I'm going to actually enter it just exactly like this. Let's do that. We're going to go then to the QuickBooks once again. We'll close this back out. I'm going to close this one back out. We're going to close this one back out. We're then going to go to our journal entry. We'll go to the company up top. We're going to go down to the Make General Journal Entries. And we're going to make the general journal entry this time as of the first day of the next month, which is going to be March 1st. And notice I made that adjusting entry as of the 28th, I think, which it should have been the 29th, but that's okay. We're going to make it as of the first day of the next month. Now, note, we're not going to try to match it up with the actual invoice date. Don't want to do that. It was on the 2nd because we want to make the reversing entry right on the first day of the next month because that makes them easy to locate. And so it's less confusing. So especially if we're dealing with an adjusting department that's different than the bookkeeping department, we don't want to confuse them any more than we have to. So, the adjusting department doesn't want to confuse the accounting department, make anybody more mad than we have to. If it's a reversing entry, it'll be on this day, and that's the reversing entry. And if you have questions with that, we'll let you know. Other than that, it's not us, right? It's not the adjusting department that messed everything up. We want to have them all easily as transparent as possible right there. So we're going to make them as of the first day. And we're going to say that the accounts receivable will be first. So we're going to say accounts receivable. And that's going to be for the 525. It'll be a credit now because it's going down, 525. I'm going to put this will be a reversing entry. And we should clearly label that too so that it's well known that that's one of them funny reversing entries. And we're going to need a name because it's in accounts receivable. So it's Sam the Guitar Man once again. The next we're going to have the sales. So the sales is going to be merchandise sales. So merchandise sales, that's going to be for 500. It's going to be a debit, decrease in the merchandise sales. It's going to be a reversing entry. Don't need a name there. Next, we're going to have the sales tax payable. So we'll say sales tax payable for the 25. And we're going to need a vendor here, and that's going to be the New York tax collector. Then we're going to have the cost of goods sold credit of 400. So cost of goods sold credit of 400. Whoop, not 4,000. 400, 400, 400. And that's going to be a reversing entry here, reversing entry here. And finally, we'll have the inventory. It should be, right? Inventory, the debit. So we'll put that here. That's going to be inventory. And there's the 400. Now, again, this journal entry should look kind of funny to you. It should look like, well, we're making the sales go down. It's kind of like a credit memo. It's like everything's kind of reversed. It's not natural to us after we've memorized normally recording invoices most of the time. That's why you really want to think of the invoice first and then reverse it exactly. We're going to go ahead and save this and see if it does what we would expect it to do. What do we expect it to do? We expect it to have the, as of the cutoff date, have included this invoice in the cutoff date or before the cutoff date in revenue and in all these 4 accounts. And then after the cutoff date, we'll have the original invoice as well as the reversing entry to cancel out the fact that it would be in there twice as of that point. So we're going to say save and close. So now we're going to be back to our balance sheet. And if we look at the balance sheet as of 3/15 and go through this information, we've got then the accounts receivable. If we open up the accounts receivable and scroll down, now we'll see our 3 numbers here, right? We've got the journal entry, which is the adjusting entry, as we can see here, and that makes it right as of the cutoff date so that the amount is pulled into the correct time period. Then we reversed it. We reversed it as of the beginning of the month. So we reversed it as of March. And then as of the actual invoice date, there's the actual invoice to match out. So this pulls it up to make it correct. And then this cancels out the other one so that we're left with basically the original invoice as of the invoice date that it was actually input of the 5/25. Closing this back out, same kind of thing happens on the inventory. So double clicking the inventory, then we have the journal entry of the adjusting entry, or decreasing the inventory. We add it back with the reversing entry as of the first day after the cutoff date period. Then as of the invoice date, those two will match each other out. Closing this back out, now our inventory will match once again what the sub-report will have with the actual inventory data because we've canceled out that journal entry that kind of threw us off by the 400 last time. Then we'll have the same thing, of course, in the sales tax payable, double-clicking the sales tax payable. Scrolling down, we'll have the 25 for the adjusting entry, the reversing entry as of the first day of the next time period, and then the actual invoice. Let's close this back out and take a look at the profit and loss statement. If we take a look at the sales then and scroll down, same thing. We've got the sales being increased as of the cutoff date. Then they are decreased as of the first day after the cutoff date. And then the invoice will basically cancel each other out. So in essence, these two cancel out so the actual sale isn't recorded in March, even though the invoice date is there because we pulled it back into, it is recorded in March. It's not recorded in February. It's reversed out of February and recorded into March. Okay, closing this back out, the same happens with the cost of goods sold. Double-clicking the cost of goods sold, we then once again have the adjustment as of the end of the time period. Then we reversed it after the last time period, and that cancels out basically the invoice. So that means that as of the end of March, if we go to the end of March, 02/28/20, that, if we double-click here, is where the actual increase happens. That's where the adjustment happens. That's where the sales are increased. If we then go to the beginning of, that's at the end of February, end of February, that's when all that happens. If we then go to the first day of March, which is going to be 03/01/20 to 03/01/20, this looks funny because now we have a reversing entry happening here and we have negative sales. That shouldn't happen. That's going to confuse people, right? When I sent this to the account, they're going to go in here and they say, what is going on? And then they're going to go, oh, that's some reversing entry if there's 2 different departments doing this. And we're going to say, yeah, it's a reversing entry because we pulled in one invoice because it was thought that it needed to be in the other time period. We didn't delete the invoice or change the date. We just made an adjusting entry and then we reversed it as of this time period. And they're going to go, all right, whatever, and just leave it there. And then as of the second date, so that's going to be wrong until you get to March 2nd when the actual invoice was made, and then it'll cancel each other out. So again, that means that we don't enter the reversing entry as of March 2nd, because then all the reversing entries will be in scattered dates. What we're going to do instead is say, I know it's going to be wrong for a couple days, but we're going to enter all reversing entries into March 1st, just like we're okay with making the adjusting entries at the end of the time period and allowing the system not to be on a perfect accrual basis for the rest of the month, because we know that it's better to have a functioning system than to have a perfect accrual basis throughout the entire time period. So that's going to be the rationale of it. Let's take a look at the trial balance and see where we are at. Check the numbers so far. We're going to go down to the accounting and taxes, take a look at the trial balance. We'll change the dates to 01/01/20 to 02/28/20. You can then take a look at the numbers, see if they tie out. If they do, great. If they do not, then you can check a look at the dates, see if it's a date thing. Then you can zoom in and see if you can figure out what the difference is. If you can, that's great. If you would like to push forward or move forward with the problem without doing that, and then you can take a look at the backup files. We should have backup files that will take you to the precise point in the problem, and then you can push forward from there.